Hello everyone, I hope you are doing well. Today we are going to explain chapter 16, which is cost allocation, joint product and byproduct. Actually, this is chapter number 4 out of our syllabus, and it is in the book as chapter 16. The first of all, we have to be aware of some terminologies that are used within the joint cost terminology. Actually, the joint cost is the cost of production process that yields multiple products simultaneously, which means this is a cost to be incurred by the company in order to produce or result in more than one product, Split of point is the point in a joint production process where two or more products become separately identifiable, which means if I have something like that, here this is the split of point. From that point I will have more than one product. يعني for example, if I talking about raw milk that can be obtained from the farm, and then it will go into some maybe pasteurization or heating. In that point, I then can split the amount of milk here, the raw milk that I have here, into, for example, ice cream and cheese. So actually, if you are looking here, what will be incurred before the split of point, it is called the joint cost. This is cost of production that can yield after the split of point into more than one product. So actually this cost, we call it the joint cost because actually it is related to all the product that will be resulted or will be produced after the split of point. So actually this is the joint cost, the cost that will be incurred for multiple products. The split of point is the point where the joint production process will result in two or more products that can be separately identifiable. And then we have the separable cost. Separable cost is any cost that you are going to incur here on one of these products in order to yield a new product. Yani for example, I resulted here in a cheese. I can add some cost, additional cost, to make that a cheese, for example, white cheese or creamy cheese. So actually, the separable cost is a cost that will be incurred in addition to the product after, in addition to the cost of producing the product after the joint cost, or as a split of point, in order to yield in a new product that can be sold in higher or lower price. So the separable costs are all costs incurred beyond the split of point that are assignable to each of the specific product identified at the split of point. The main three terms that we are going to use here: joint cost, split of point, and separable cost. The main product, whatever will be resulted after the split of point, is a main product, the output of the joint production process that yield one product with high sales value compared to sales value of the other output. So this will be considered the main product. The joint product, output of joint production process that yields two or more products with high sales compared to the value of any other output. And then we have the byproduct. The byproduct is the output of joint production process that have low sales value compared to the sales value of other product. Again, if we have this line, this is the split of point. If we have two products that can be sold at a higher value, so actually this is main product. This is main product. If we have other product with low sales value resulted from the process of preparing the other two main products, this is to be called the byproduct, and it is always having a low sales value compared to the sales value of the other output. Okay, examples of joint cost situation: for example, agriculture and the food processing industry. cocoa beans can result in separable product at split of point, cocoa butter, cocoa butter, cocoa powder, cocoa drink, and so on. Lamps, lamb cuts, tripe, hides, bones, and so on. We have extractive industries, like here, petroleum, we have crude oil and natural gas. Salt, we have more than one product, chemical industries, and so on. So actually, those are examples of industries that we can look at, okay, and they are making or incurring additional cost in order to have severable product at the split of points. Here we have two approaches to allocating the joint cost. We have market-based and we have the physical measures. Actually, if you are looking here, let me remind you again. We have that line, the split of point. Then we have more than one product. Okay. Each of these products will have a separable cost that can be directly traced to that product. But what about the joint cost that happened before the split of point? How we are going to allocate it? Because actually maybe here I paid $1,000 and I would like to allocate it to the three products, the three main products after the split of point. The theory is telling us that we have two main approaches, the market based, which allocate using the market data, and the second one, which is the most easier, which is the physical measure, allocate using tangible attribute of the product such as pounds, gallons, barrels, and so on, depending on a physical measure of the product. Let's go and see how each one will be applied or implemented through our slides. Actually here the joint cost illustration saying that we have a processing, we have raw milk. The raw milk is 110,000 gallons, as you can see here, and we incurred a joint cost of 400,000 until we reach for the split of point. After the split of point, we divided the product into two, the raw milk into two main products, the creme and the liquid skim. The creme with 25,000 gallons and the liquid skim with 75,000 gallons. Okay, and our main concern here is what shall we do with this joint cost? This joint cost, how we are going to allocate that over the creme and the liquid skim. This is the full information. He is saying that the joint cost of 110 gallons of raw material, raw milk, and processing to split of point is 400,000. The creme beginning inventory is 0, liquid skim is 0. Production, which is gallons, 25,000, 75,000. Sales is 20,000 and 30,000. Ending inventory is 5,000. Of course, 25 minus 20 equal to 5,000. Again here 75 minus 30, which is 45,000. The selling price per gallon after the split of point, if we are going to sell it, is $8 for the creme and $8 for the creme and $4 for the liquid skim. We will start by the first one, which is we are under the marketing approach, and actually we will start by the sales value at the split of point. The sales value at the split of point method allocate the joint cost to the joint product produced during the accounting period on the basis of relative total sales value at the split of point, which means we will see how much sales should be achieved in relation to each product, and I will allocate the joint cost based on that amount. A prorata. This method uses sales value of the entire production of accounting period, not just the quantity sold. And this is a very important point. Here we are in this method, we are using the sales value of entire production, not only the quantity sold during the year. The sales value at split of point method follows the benefits received criteria of the cost allocation. طيب, this is the way of doing it. طيب, I will start by allocation of joint costs. We have creme and we have liquid. What is the sales value of the total production at split of point? Actually, as you can see here, it is 25,000 gallons multiplied by 8. All of that were given in the previous slide. 75,000 gallon multiplied by $4. So actually it is 200,000 and 300,000. The total is 500,000. I will start to prorate, which means I will divide the 200,000 by the total, which is the 500,000, which represent 0.4. And I will divide the 300,000 over the 500,000, which is 0.6. So the joint cost allocated is 0.40 and 0.60. I will multiply the 0.4 by the 400, which is the joint cost, and I will multiply it by 0.6, which means that the part that will be allocated to the creme is 160,000, and the other part, which is 240,000. This means that the joint production cost per gallon, if I would like to know, I will divide the 160,000 over the number of gallons, which is 25,000 for the creme, and the 240,000 divided by 75,000 for the liquid skim. This will result that the joint production cost per gallon is 6.4 for the creme, 3.2 for the liquid skim. So up till that point, all what I did is that I allocated the joint cost over the two main products using the sales value at split of point. Okay, type. The next step, still we are under sales value at split of point. We would like to make a simple partial income statement. Okay, revenue is 160 and 120. How can I say that? Although you said here it is 25,000 by 8, which is 200, we said that in the allocation process or panel we are using the whole production. But while we are preparing the income statement, we have to use only the part that have been sold, and we only sold 20 gallons. The selling price is 8, so actually the creme is 160,000. The other product, which is liquid creme, we only sold 30,000 gallon. Okay, multiplied by 4, which is 120. So the total revenue is 280 minus the cost of goods sold, which is the joint cost. Okay, the cost of goods sold will be production cost, okay, which is 0.4 multiplied 400, the 160 that we already calculated here, and the 240 that we calculated there. So I will go then and deduct the ending inventory. The ending inventory, 5,000 multiplied by 6.4, this is 6.4, and 45, which is remaining because actually we produced 75, we sold only 30,000. 45,000 multiplied 3.2, and the cost of goods sold will be 128,000. 160 minus 32, 240 minus 144. So actually the cost of goods sold is 128,096. The gross margin will be subtracting the 128 out of the 160 and the 24 out of the 120. So actually, sorry, the 96 out of the 120, so actually it is 24,000. What is the gross margin percentage? I will divide the 32 over the 160, the 132 over the 160, and the 24 over the 120. So actually the gross margin here is 20% and here is 20%. Very good. The second method, which is the physical measure method. The physical measure method, and this is very obvious. The physical measure method allocates the joint cost to joint product produced during the accounting period on the basis of comparable physical measure. On the basis of comparable physical measures such as relative weight, quantity, volume at a split of point. طيب, let's go for the numerical example. Again, here instead of starting by the revenue, I will start as we did in the first method. Actually, this method is emphasizing on the physical measures. So actually, the physical measures telling me that we already produced 25,000 gallons and 75,000 gallons, and I will start to prorate the two products based on the physical measure. This means that the total is 100. So actually, as if the creme is representing 25% out of the 100, and the liquid skim is representing 75% out of the 100, and we are going to allocate the joint cost based on that amount by multiplying the percentage, the weight that we arrived here, by the 400,000. So the share of the creme is 100,000 because 0.25 multiplied by 400 and 0.75 multiplied 400, okay, which means this cost or this allocation, this share of cost, which is the 400, is 100,000, and this one is 300,000. This means if I divided the 100 over 25,000, it will be $4 per unit, and over the 75,000, it also will be $4 per gallon. To prepare the partial income statement, as we said, I will start getting only the sales already happened. Whenever we are doing the income statement, we have to stick with the actual number of units sold. So actually, I will get the 20,000 by 8, which is the selling price, and the 30,000 multiplied by 4, which is 280,000, and then the production will be the 400,000 multiplied 0.25, which is 100. Oh, I can take it right away from here, and the 300,000 right away from here. So I will deduct the ending inventory, the remaining, which is 5,000 and 45,000 by the cost that I already incurred, and the cost will be 80,000, and I will deduct this 80,000 out of the 100. I will deduct this 80,000 from the 160, and I will deduct the 120,000 out of 120,000. So actually the gross profit here is 80,000, and here is 0, because actually the revenue is equal to the cost. The gross margin, if I divided the 80 by the 160, it represents a gross profit of 50%. If I divided, of course, 0 by 120, it is 0. So the average here for the total, which is the 80 over 280, will result in an average of 28.6%. Okay, this is the physical measure example. Right. What about the net realizable value method? Actually, the net realizable value method is telling me that we have to have the final sales value minus the separable cost. We allocate the joint cost to joint product produced during the accounting period in the basis of relative net realizable value. In many cases, products are processed beyond the split of point to bring them a marketable form or to increase their value above their selling price at the split of point. Yani, for example, if I'm going to do that like we did in the previous slide, this is the split of point. We said that we maybe after the split of point we'll have more than one product. What if these products must be furtherly processed, which means we are going to incur additional cost in order to reach for a product that we can sell in a respectable value. This method is used for that case, which means we will have the final sales value of that product minus the separable cost. This is the separable cost, this is the separable cost, this is the separable cost, in order to find out what we call it the net realizable value, and then we will allocate using the amounts that have been resulted. The net realizable value method, actually the net realizable, as we said, we started as always with the main raw materials that we are using. Then some processing will be made. Joint costs have been incurred. At the split of point, it separated into two main products, creme and liquid scum. And the production manager was not satisfied with two only main products. He thought that if he further processing that product, the creme, he will get another product which is butter creme that will be sold for a higher price, and if he further processing the liquid skim, he will get another product which is the condensed milk, and it will be also sold for a higher selling price. So actually here we would like to allocate this joint cost over the two products, as we can see. Actually, this is the full information as usual. The 100,000 gallon of raw milk, 400,000 joints cost, the separable cost of processing the 25,000 gallons of creme into 20,000 gallon butter creme is 280,000. Separable cost of processing the 75,000 gallons liquid skim into 50,000 gallons of condensed milk is 520,000. And this is the additional information. Beginning is 0, production is 25, 75, 20, and 50. Transfer for further processing gallons, the 25 all will be further processed in order to yield the 20, and the 75,000 will all be further processed in order to get the 50,000. Sales is 12,045. I'm not going to sell these two products because I'm going to further process them in a full capacity. Ending is of the creme and liquid is 0, but actually in the butter creme we sold 12 out of 80, so actually the remaining is 8. We sold 45 out of 50, the remaining is 5,000, so this is the ending inventory. The selling price here is 8 and 4, and for the butter creme is 25, and for the condensed milk is 22,000. As you can see here, we will start by getting the net realizable value. I will start by the final sales value of the total production during the accounting period for the end product, which is the butter creme and the condensed milk. As you can see here, we have 20,000 gallons. We don't care about how much did we sell. We are talking about the full production of the final product, as we did in the first method, if you remember, the sales value. And I multiplied the 20,000 by $25, which is 500,000, and I multiplied the 50,000 by the $22, which is 1,100,000. It is 1,600,000. We will deduct the separable cost, and the separable cost were given 220 and 580. 280 and 520. So I subtracted that from the 500, and I subtracted that from the 1,100,000. So actually the net realizable value at split of point is 220 and 580 with total of 800. So actually again I will divide the 220,000 over the 800. It is 0.275, and I will divide the 580 over the 800, which is 0.725. So actually this is the weight that I'm going to use in order to allocate the joint cost. This will be multiplied by, as you can see here, by the 400,000, which is the joint cost. So in the first column, the joint cost part that will be allocated to the butter creme is $110,000, and for the condensed milk is 290,000, which is 400, and the production cost per gallon will be, as you can see here, $100,000 plus 280,000. From where did we get that numbers? The 110 is the part of the joint cost here. This is one. And we have 200 separable cost, 280. So actually here the addition of both will yield in the total cost, that whenever we divide it by the 20,000 gallons, we will get the cost per unit, including joint and separable cost. The same will be done for the condensed, which means I will add the 290 and the 520, and I will divide it by the 50 gallon. Then the cost per unit is 16.2. I will go right away to do the partial income statement, starting by revenue, and again the fourth time whenever we are doing the income statement, I'm going only to include the unit sold. So I multiplied the 12,000 by 25 and the 45,000 by 22, which is 300, 990, 1,290. The cost of goods sold, I have a joint cost that I already calculated here, the 100,000, 110,000, and the 290,000. And I have separable cost, which is 280, and also this is here. This is here. Actually, 420 will be there. Okay. So I will deduct the ending inventory, which is 8 gallons multiplied by 950, sorry, 19.5, and the 5,000 by 16.20 in order to get the cost of goods sold. And then to subtract this cost of goods sold out of the sales in order to find out the gross margin. And then the gross margin percentage by dividing the 66,000 over the 300, as you can see here, and the 261,000 over the 990,000. Okay, and at the end the total 327,000 over 1,290,000, which is 25.3. The next method is the constant gross margin net realizable value method. The constant gross margin percentage method allocates the joint cost to joint product produced during the accounting period in such a way that each individual product achieve an identical gross margin percentage. يعني the main criteria here is to achieve an identical gross margin percentage. And this method works backward, that the overall gross is computed first. يعني in all the other cases, the last thing that we calculated was a gross margin method. Here we are doing the gross margin method at the beginning, and then the joint costs are calculated at the residual amount by subtracting separable cost and gross margin from the final sales value. Let's see the steps for doing the constant gross margin percentage net realizable value method. It has 3 steps. The first one is to compute an overall gross margin percentage, and then to compute a total production cost for each product, and then to compute the allocated joint cost as the residual after subtracting that from the final sales value. Let's see it in a numerical example. First, here I will allocate the joint cost using constant gross margin percentage net realizable value, which means the final sales value here, if you can see it, $20,000 gallons multiplied by 25 plus 50,000 gallons multiplied by 22 gallon, and actually here we are talking about again the total production, not what has been sold only. And here we are dealing with the number as totals. Okay, so actually this is the final sales value. I will subtract the joint and separable cost as we did last. The 400 is the joint cost, 280 and 520 is the separable cost was given. The gross margin is 400. Then I will divide the 400 over the 1,600,000, so the gross margin is 25%, and this is the gross margin that we are going to use in allocating the joint cost. Go back for our 2 final product, butter, cream, and condensed milk. I will start again by doing the final sales value of total production. Again, this is the numbers that I already did here in total. I will did it in individual basis, 20,000 gallons by $24, $25, it is 500. The second product, 50,000 by 22, which is 1 million. The total 1,600,000. This is what we have calculated here. Then I will deduct the gross margin using the overall gross margin percentage. We said that we would like to have 25% gross margin. So it is very easy. I will multiply the 500,000 by 25%, and this will be the gross margin. The same will be done for the 1,100,000, and the total gross is 400, and this is what we have here. Then the remaining will be considered the total production cost. Okay, if I for the product, for the buttercream here, I have 375,000 cost. If I deducted the separable cost, which is 280,000, the remaining will be considered as the joint costs that have been allocated for the product. And the same here, I have a total production cost 825,000, and the separable is 520,000. So the joint cost allocated is 305,000. At the end, we reach it for the allocated joint cost for each product. For preparation of the income statement, again, I will go for the actual number of units sold, 12,000 by 25, 45 by 22. Then I got the joint cost from A, which is the 95,000, and the 305,000, and the separable cost, this is given, we know it, which is 280 and 520, and this is the total production cost that we already have here. I will start deducting the ending inventory, the 8,000 multiplied by 18.75 per gallon, and 5,000 by 16.5 gallon. From where did I get that? I divided the 3,750 divided by the number of units, and we have divided by the number of units, as we said. So the total production cost here, the 8,000, that is the ending inventory multiplied 18.7, and the 5,000 of the second product multiplied by 16.5, and this is the total cost. So actually we reach it for the gross margin, and the gross margin percent will be dividing the 75,000 over the revenue. You will find it 25,000 as we decided from the beginning. So this is the constant gross margin net realizable value. Okay. Which method to be allocated? Actually, if selling price at a split of point is available, the sales value at split of method is preferred, even if further processing is done, because actually it will be the best measure of the benefit received, and it is independent of the further processing decision. It has a common allocation base, which is revenue. It is very simple to be applied. If the selling prices are not available, then the net realizable value is the best alternative to be used. Despite this, some firms choose not to allocate joint cost at all, which means it will include it in the income statement and not to allocate it to each product individually. Accounting for by product, we have two methods for the by product accounting, which is the production method and the sales method. The production method recognizes the byproduct as it is created and sales and cost at the same time. The production method is considering any byproduct inventory as an inventory whenever it is created, and it will be sold, and whatever the cost will be, it will be deducted out of that revenue. The sales method recognizes no byproduct inventory and recognize only sales at the time of sales, and the byproduct are not tracked separately, which means we are only recognizing the revenue coming from the byproduct, and we do not consider any of the cost in doing that. This is the two methods, as you can see here. This is the revenue, main product, fine grade lumper, for example, and the byproduct. In that case, in sales method, we consider a sales value for it, but actually here we didn't. And we will have the total revenue. Then the cost of goods sold, total manufacturing cost is 250 and 250. Here I will, in the production method, I will consider it as expense. Sorry, I will consider it as a deduction from cost. So this is why I subtracted from the total manufacturing cost. Okay, and then I will deduct the main product inventory, as you can see here, and this will be the cost of goods sold, and the gross margin percentage will be like that. Yeah, but in the first method, I'm not considering it as revenue, I'm considering it as a reduction in the cost. But in the sales method, I will recognize it as sales, okay, because actually it has been sold for an amount of money. Which one is to be used? The production method is consistent with matching principle and is the preferred method. The production method recognizes the byproduct inventory in accounting period in which it is produced and simultaneously reduce the cost of manufacturing the main or joint product, thereby better matching the revenue and expenses from selling the main product. Sales method is simpler but allow a firm to manage reported earning by timing the sale of the product as the desire of the management, and actually this can help management in avoiding or manipulating revenue. Actually, this was the last thing to be discussed in that chapter. I hope you understood everything we said. Thank you for your listening. See you in the next chapter, inshallah.